One of the most important things that I see a lot of times traders get wrong is they use all put butterflies when they're trying to put on a bullish trade, or they're using all call butterflies when they're trying to put on a bearish trade. So the first thing that we need to understand is that if we're trying to put on a trade and our outlook is bullish, we have to use all calls to construct the butterfly. And if our outlook is bearish, we're going to use all puts to construct a butterfly. Let's take an example here. This is a all call butterfly, and it is constructed. It's made of two spreads. We have a call debit spread and we have a call credit spread. So here we have this, I think this is SPX, SPX at 3112. And let's assume that we had a bullish outlook and we wanted to put on a bullish call butterfly. This butterfly is made of two spreads, which is 3100, 3140. This would be the first debit spread. Right? This is 3100, 3140. And then we have a call credit spread, which is 3140, 3180. So here we have two spreads that make up this butterfly. Both spreads are being put together using all calls. And we have 3100, 3140, which is a debit spread. And then we have 3140, 3180, which is a credit spread. Now, because this credit spread does not have enough premium to cover the cost of the debit spread, this is going to be a net debit transaction. And this net debit is the risk in this trade. And that's, in other words, this is the most that this butterfly can lose. So for example, I believe this this butterfly is going for something like 1250. So 1250, which is a debit, to put this trade on, that's the most that this butterfly can lose if the price of the underlying security, well, in this case, SPX, is below 3100 at expiration or above 3180 on expiration. And if SPX is going to be somewhere inside of the tent between 3112 and about 3166, this is where this trade is going to make a profit. So while SPX is trading at 3112, in order for this butterfly to make a profit, we need to assume that the price is going to be somewhere between 3112 and 3166. And we need our, number one, our outlook has to be bullish. That's number one. And number two, we need to size this position in a way that this 1250, which is what's at risk, if this is not a 100% risk trade, but we need to assume that we can lose probably about 50% of this if we are wrong on the direction of the underlying. Now we can say the same thing about using a all put butterfly. So if let's say we were bearish on the price of SPX in the near term, and we wanted to put on a directional butterfly, we would construct this butterfly using all puts, and this butterfly would be put together by buying a put debit spread which is 3100, 3070. And we would sell a 3070, 3030 put spread to help pay for the debit spread. So 3100, 3070 is a debit spread, and 3070, 3030 is a credit spread. And just like with the out of the money call butterfly, the credit spread does not have enough premium to cover the cost of this debit spread. So this position would be a net debit trade. And in this case, this butterfly is going for $500, and that is the risk in the trade. This covers the directional assumption. And I hope this is clear that if we're bearish, the reason why we want to place this butterfly out of the money to the downside is so that the debit spread that we're buying here is going to increase in value if the underlying starts to move in the direction of this trade. And then we have the credit spread here is only used to offset some of the cost associated with this debit spread. Right, so we had a couple of questions, and we'll just go through these questions, and I will have you guys on your way. So the first question was, how far out of the money should we get when playing directional butterflies? So an out of the money butterfly should be placed in the direction of the anticipated move. As I just mentioned, if we're bullish, we want to place a call butterfly out of the money to the upside, and if we're bearish, we should be placing a put butterfly out of the money to the downside using all puts. Now we can use a couple of different ways to figure out how far out of the money should we play these butterflies. We can use an expected range to give us an idea of what is currently being priced in by the markets, and see if we can place our short strike somewhere around the expected range. Or we can look at potential levels of support or resistance just based on the chart, and we can look to place our short strikes somewhere within the anticipated level of support or resistance. Now I'm going to switch over to Optionet Explorer for a second and just take a quick example of a trade that I would set up. This is just as an example. This is Tesla, and let's assume that we had a bullish outlook on the price of Tesla in the next couple of weeks. We would be looking to put on an out of the money call butterfly. And what I did here, I looked at price of an at the money straddle, which is somewhere around 25 points or so. So I went ahead and I placed my short strikes at 375, which is about 25 points out of the money. And then I used $50 wings, or 50-point wings. And this is what this trade looks like. So we have a long 350, 375. This is a debit spread. And then we have 375, 400 credit spread. Now this trade is currently going for about 480. And that's my risk in this trade. and this trade is going to make a profit if the underlying moves in the direction towards the short strike, which is right at 375. And then we can look at how this trade makes money over time. Right, we can see that if Tesla moves towards 375, but it moves rather slowly, right, our T+0 line is going to pull, and it's going to actually improve over time. So a couple of lines here. The red line is a T+4. Right, the gold line here is T+12. So in 12 days, if Tesla is trading somewhere around the 375 strike, this butterfly has a potential to make about 160 or 170%. So what we're anticipating is two things. Number one, we're bullish. And number two, we need the move in the direction of the short strike, but it has to happen slowly. So as far as how far out of the money we play, there's really no black and white, or there's no, cut and dry answer. We can, I put my short strikes at around levels where I anticipate the move or the underlying to land inside of the time frame. So for example, in this example here, we have 16 days until expiration. So over the next 2 weeks, if I feel that Tesla is going to move towards 375, that's where I put my short strikes. And obviously this trade makes the most if the underlying is trading somewhere around the short strike. So the next question is, why should we be doing balanced butterflies when broken ones give us credit? Is there an argument when to use what? And I think this is a very good question, and maybe this question is a topic that we can debate and look at difference between broken wing versus balanced butterflies. But I don't really want to get into broken wing butterflies, because by breaking the wings, we are expressing our directional bias. And I think that by placing balanced butterflies out of the money, we are essentially expressing our directional bias. So it's kind of the same thing. So for me, I use balanced butterflies when placing short strikes out of the money. Broken wing butterflies may be entered by collecting a credit, but the trade-off is the increase in buying power reduction. If I have a directional assumption and would like to place my butterfly around. So for example, if I wanted to use the same butterfly here in this example for Tesla, and let's assume that I was bullish, but I wanted to use a broken wing butterfly, I would go with, instead of using an all call butterfly, maybe I would do an at the money short 350 put, long 325 put, which will give me a credit. And then I would sell a 350 call, and I would buy, instead of a 50-point wing, maybe I'll just buy a 10-point wing. Right, so this will be a bullish butterfly, except I'm not placing this butterfly out of the money. I'm placing this butterfly at the money, but I'm breaking the wing on the upside to express my directional bias, and I am collecting a credit. But this credit doesn't really mean that this is a better trade than if I was to enter an out of the money call butterfly paying a debit, because this credit here doesn't just remove my upside risk. It just shifts my upside risk to the downside. So whatever risk I would be taking with an out of the money call butterfly on the upside, it removes that risk with this broken wing butterfly and moves that risk onto the downside. So I have more risk on the downside, and the trade-off here is that because I assume more risk on the downside, I don't have any risk on the upside. So I don't think that broken wing butterflies are better than out of the money balanced butterflies. I think that the easiest way to do it is to pick a direction in which you think the underlying will be trading over however long, whatever your time frame is. So in this example, it's 16 days. If I thought that Tesla will be trading at around 370 2 weeks from now, then maybe I'll just place my short strikes at 370 and then use a 20-point wing, right? So I am long 390, short 2 370s, and then long at 350. So this is a balanced call butterfly centered at 370. It's currently going for about $357. That's my maximum risk in this trade. And this trade makes the most if the underlying is trading at around the short strike, which is 370 2 weeks from now. And we can see what this trade would look like if we were correct on our directional assumption and Tesla was trading at 370 14 days from now. This trade with probably return somewhere around 200% return on the risk that is in this trade. So the next questions are, what are the preconditions for a directional butterfly? And again, I don't think that there's any specific entry signal for a directional butterfly other than our own outlook for the price of the underlying. I know that a lot of traders like to overcomplicate things, or they try to build in some sort of a signal that will tell them when to enter the trade. But the reason why we're using out of the money call butterflies, it's not dependent on any particular signal. If you're bullish on the price of the underlying in the near term, then you are going to look at potentially placing an out of the money call butterfly. If you are bearish on the price of the underlying in the near term, then you should be looking at placing an out of the money put butterfly. There's no specific conditions, in high volatility, low volatility. Sure, volatility would help, and butterfly being short volatility trade will benefit from volatility contraction overall. But if we sit around and wait for volatility to be super high, and then we have to be right on our outlook on the volatility on top of being right on the outlook of the price of the underlying, it's just, putting way too many variables and having way too many moving parts in this pot. So instead, again, keeping it very simple is key here. If I'm bullish, then I'm going to look to place an out of the money call butterfly. If I'm bearish, I'm going to look to place an out of the money put butterfly. And that's what I wrote in my notes here, pretty much, just to summarize this. An out of the money butterfly is a directional trade in nature, and our outlook has to align with the initial delta of the trade. We need to be right on the direction of the underlying. That is the most important part. If we're putting in an out of the money call butterfly because we're bullish and the stock or ETF or whatever it is that we're using is going in the opposite direction, it's not the butterfly's fault that it's not working. And I think that we just need to reconsider our trade altogether. If we're bullish and we're placing a trade out of the money to the upside and the stock is moving down, clearly we're wrong. It's not because the conditions aren't right, or there's nothing else other than the delta exposure is going to dictate whether this trade is going to make money or lose money. Sure, over time, it's going to help to the decay of all options in the trade. But initially, we need to be right on the direction. So if we're bearish and we're placing the butterfly out of the money to the downside, we need the underlying to move towards our short strikes. Theta in this trade, you know, an out of the money butterfly is a theta positive trade. So sure, decay will help, not initially, but over time. And I'm going to switch back over to OptionNet Explorer here for a second. So we're looking at the example that we just used in Tesla, and you know, this is assuming this is a bullish trade centered at 370 with 20 point wings. If we're wrong and Tesla goes down, it doesn't matter what volatility is doing. If volatility is up, that's not going to help. If volatility is down, that's not going to help either. We need to be right, and the underlying security has to move towards the short strike here. Now, if we're going to be right on the direction and Tesla goes up from 350 towards 370, sure, decay is going to help, because think about what's happening here. We have short 370s, right? We're short these calls here. So we are long 350, and if Tesla's going higher, right? So 350, 370 debit spread is going to increase in value. And then if this move is happening rather slowly, the slower it moves, the more this credit spread here at 370, 390, it's going to lose value. And that is going to push our T+0 higher. Right, so we have a debit spread that's going to increase in value. We have a credit spread that's going to decrease in value because this move is happening fairly slowly. So we need to be right on the direction and a little bit on the speed, right? We can't have Tesla go from 350 to 400 because clearly we're going to be wrong, and being short this 370 to 390 is not going to help. So decay only helps if the move is happening and we're inside of the tent somewhere around the short strike, and decay is happening on the short credit spread. The best scenario for this trade is a fairly slow move towards the short strikes of the butterfly. The long debit spread will increase in value while the short credit spread will decay due to time passage and the slow move in the price of the underlying. Now we're going to talk, I think this is the last question here. We're going to talk about adjustment. It's pretty difficult to make any adjustments. Is it better to just close out and move on, or does it make sense to close one of the spreads and move if it moves against you? So, and I wrote in my notes here, the butterflies are a defined risk trade, and we can control our risk by controlling how much capital is allocated to any one position. Now, let me just switch over to my OptionNet Explorer screen, and I'm going to go back. So going back to this Tesla example, so if I was bullish and I placed my trade out of the money around 370, my risk in this trade is $357. So if my total risk, let's say per trade, according to my trading plan, was don't lose more than $1,000 per any trade, right? Knowing that each butterfly could lose, if I lose 100% of my debit paid, I'm out $357, then I will probably size my trade accordingly. I wouldn't go more than 3 contracts. So I can control my risk that way and not have to worry about making any adjustments if the trade is going against me. And this is a very common mistake that a lot of traders make. They don't really understand the risk in the trade, and they don't size their trades according to that risk. They're just trying to size these trades according to how much money they want to make. So that's one thing I would do, is I would keep my size relatively small, assuming that, hey, if this thing goes against me, I can lose 50% of my $357 per one butterfly that I'm paying to get in. What I also can do, if I really wanted to make an adjustment, if I had to make an adjustment, I couldn't assume full risk in this trade. One thing I can do, let's just assume here that I have Tesla go down, move against me, right? And now I'm starting to take some heat on the downside, and I needed to make an adjustment. I made a note here. If we wanted to make an adjustment to any butterfly, we can roll the tested spread up or down to convert a butterfly into a condor, right? So what that means is that if Tesla's moving against me, right, I have two spreads. I have spread number one, which is a debit spread, and spread number two, which is a credit spread. So if Tesla's moving against me and my debit spread is taking heat, I can take this debit spread off for a loss and move this debit spread lower, essentially converting this into a condor, right? And this is what my condor would look like. It's going to be a skinny condor, but it's going to be a condor nonetheless, right? So I have a original credit spread here. I'm closing out the original put debit spread, and I'm opening a new debit spread. And this adjustment is going to be done for a net debit, which means that my total risk in this trade is no longer $357. If I have to add more capital to this trade, which means my risk is going to be more than $357. So this adjustment is going to make my profit area wider, but it's also going to, it's going to increase my probability of profit, but it's going to require additional funds. It's going to require additional buying power. So my net risk is going to increase. We're going to talk more about these butterflies. We're going to continue to talk about out of the money, bullish and bearish butterflies. I hope this helped a little bit. I'm going to share these slides with all members in the chat. I'm going to put this in the Slack somewhere. If you have any questions, feel free to post these questions in the chat, and I'll make another list of questions, and maybe we'll do another Zoom meeting where we can address some of these questions. I think butterflies are very dynamic. It's very flexible. It's a very powerful trade that everyone should be able to use. I know that there's a lot going on with, trying to put together debit spreads and credit spreads and try to manage all moving parts at the same time. But I think that if we continue to have this conversation and continue to address different questions that come up, I think it's going to be beneficial to all members of our group.